Hello again, or welcome to What the Finance, breaking down the complex world of finance, investing, entrepreneurship, and trading to make it accessible for all. Today, we are privileged to be hosting Professor John Lyon on the podcast. John has had a 40-year career in accounting, corporate finance, venture capital, and entrepreneurship. Originally starting as a clinical researcher in the NHS, John pivoted to the business world. Starting at PriceWaterhouse as a chartered accountant, John has since worked as a management consultant and a global vice president at major corporations, as well as being an entrepreneur and venture capitalist. He's now a professor of practice at the University of Warwick and recently co-founded Panthera Biopartners, one of the fastest growing companies in the UK. John talks about his research and experience as an entrepreneur, the challenges of scaling up a company, and common mistakes startups make. If you enjoy the podcast, please like, comment, and share so we can have other great guests similar to John. Hope you enjoy. So John, thank you so much for joining us today.
That's my pleasure.
No problem. So I'm going to ask you the same question I asked Simon. So was there a moment you realized you wanted to pivot away from sort of biochemistry into the business world?
Yes, there was. And many years ago now, I'm afraid, more than 3 decades ago, I worked in the National Health Service and got excellent training as a clinical biochemist. And I remember one day in the lab thinking, we can do things a little bit differently. So I went to my boss and I suggested ways of doing things differently. And he said, basically, you've got to do the job that we've asked you to do. And it was that moment that I realized that actually the scope of the work of a scientist, albeit very, very important, was too narrow for me. And I had visions and desires to do things outside of the scope of science. And I think it was that moment that made me rethink my career pathway.
Yeah, perfect. Because I know you went into sort of PwC after that, and you went more down the that road. Was that in terms of consulting, or was that just getting that business background before you started your own business? Or?
Yeah, so, I mean, that's a really good question. And you know, at that moment when I was a clinical scientist and I wanted to do something more commercial, I kind of started to think about how best to achieve that. And I knew PriceWaterhouse, as was then PricewaterhouseCoopers now, as somebody that had, you know, it was a good training ground. So effectively, I chose to do the chartered accountancy qualification with PW, really to get a grounding in business and a grounding in commercial sort of business. And I always remember the first day I started with PriceWaterhouse, and you know, this is quite a pivotal moment, because the first thing the senior partner said to me is, "You're here not to train as a chartered accountant, you're here to train as a businessman." And I always remember that, because I think for me that was so important, that I did chartered accountancy because I wanted to become a businessman, not because I wanted to become an accountant.
Yes, it's not just about the numbers. It's more about the whole workings of the business and understanding that.
Absolutely. And, you know, always the best accountants see past the numbers. The numbers are purely symptom. They look to the cause. And again, the best accountants, you look to the future and not to the past. And hence, that's why I actually moved into corporate finance pretty well immediately after training as an audit specialist. I then moved into corporate finance for the simple reason that I enjoy looking forward a lot more than looking back.
Perfect. And then from there, I know you sort of started a few of your own businesses as well. So was that just more to have that greater impact and sort of?
No, there was actually a bit in between, which is quite pivotal. And I actually moved from chartered accountancy and became a venture capitalist. And I was very young. I was only in my 20s at this time. And to some extent, it's a good training, but without the gravitas and having run businesses, I always feel that, you know, it's fine, but you can't add an awful lot of value until you've actually done it. I moved then from venture capital into large corporate and ended up as a global vice president for a company called Covance, which are a great company. Drug development, was involved with blockbuster drugs, was involved with a world-leading clinic where I was the managing director, where we did some famous pharmaceuticals that I won't mention, but everybody will know them. So that was a great, if you like, corporate experience. And also I learned a lot about corporate. So before I actually moved into entrepreneurial ventures, I actually had a good few years at a pretty high level within an American corporate and global environment, where I think I had staff in numerous countries, and all the problems with culture, the problems with politics, and actually managing people. And that was a great learning experience. I always tell my students nowadays that effectively you can learn about entrepreneurship from books, even in a corporate environment where entrepreneurship can be delivered, but actually doing it is also very important. So the experiential learning is at least as important, if not more important, than the theoretical underpinning. Both are useful, but I think you need both.
Yes.
So then, so then from the large corporate, one day I was on a plane. I'd flown to the US already that week. This is the second flight to the US that week, and I was getting to know the hostess's children better than my own, and certainly been through the wine list several times and seen the movies about 8 times. So it got a little boring. It was the same seat that I normally flew on at Virgin Atlantic to Newark from Heathrow. And I suddenly thought, I wonder if there's something else that I should be doing in life. And at that time also, I was running a consultancy division within a large corporate. So I was seeing lots of business plans from entrepreneurial ventures. And that is the thing that sparked me into really entrepreneurial life or entrepreneurial ventures. I saw a business plan that really attracted my imagination, my vision, my curiosity. And from there, it took about 2 years to then move to my first truly entrepreneurial venture from large corporate.
Yeah, perfect. And how was that shift? I know you obviously had lots of experience, but was it difficult or?
It was very difficult, and there was a lot of things that, again, you can only really know by doing. So, I'll give you one example. In large corporate, I had a couple of PAs that kind of controlled my diary. I knew pretty well what I was going to do weeks in advance. There was a corporate strategy. There was a very firm both matrix of management, but also a goal congruent. So everybody knew effectively what we're all trying to do, et cetera, et cetera. And that, was relatively stable. So you would set that at the beginning of the year and then drive it throughout the year. And that's fine. And that's corporate life. And for large corporates, absolutely essential to the corporate, if you like, scorecard. In entrepreneurial life, you can raise, a few million, and then your business plan literally within days is often out of date. I always tell my students there are 3 certainties in life. There's birth and death, putting that as one. There's taxes, and there's the uncertainty of entrepreneurial ventures. So for entrepreneurial ventures, it means that effectively, things happen sometimes on a daily basis, where you can get up in the morning and it gets to lunchtime, and actually the environment's changed, or the challenges of the day have changed, either in priority or in existence. There might not have been a challenge at 10, at 11 in the morning there is in a certain area. So you've got to be really chameleonic, you've got to be really flexible, resilient, and your ability to pivot on a almost daily basis. Now, some people hate that. Some people love consistency, they love maintenance, they love knowing what they're going to do months in advance. That is not me. And I found that out by going through this journey. And I thrive on the challenges, as long as they're not more than, say, 3 a day, and everybody's got a tipping point, but as long as they're a reasonable amount, then I actually like the flexibility, the highs and lows of those challenges, and actually looking at creative ways of actually getting over the challenge and actually finding solutions and creating solutions, often out of what appears to be nothing. So you've got to create things, you've got to find answers, you've got to be imaginative, you've got to reach out to friends of the Kirk who are in the business, and really, and that's all about teamwork. So effectively, what I've found in entrepreneurial ventures is that the team is so important. Who you work with, who you partner with, how you actually work out who you partner with. And certainly one of my research interests nowadays is looking at team dynamics, board dynamics, particularly for young startup companies or scale-up companies, which I find more interesting. So it's often the scale-up phase where there is the risk, once companies start to scale, and also building the team around that time, which most companies do. How do you get the right people? Who are the right people? How do they interact? So all of these things, again, my PhD is in that area, and that's, from an academic viewpoint, an area that I believe is of practical significance. And I'm a great believer, by the way, in research having an applied, everyday use.
Yeah, perfect. That's probably from your background of actually being a part of these massive businesses and seeing the importance of it.
Yeah.
Yeah, perfect. I've actually, that sort of links to one of my other questions. So you've co-founded a clinical trial company in 2019, and I
Indeed.
can imagine you've had a lot of scaling up in the past year or two.
Absolutely. It's probably one of the fastest growing companies in the UK at the moment. So I co-founded it with a very good friend of mine that I spent a number of years getting to know. And that's pretty important. First of all, your co-founder, can you work with he or she? In my case, it's a he. Are you complementary? And it's not about lots of, me too think. So it's the complementary skills. In this case, my co-founder is an excellent medical doctor, but he's also extremely commercial, and that's quite unusual, by the way, to find. It's certainly in this country, not in other cultures, but certainly in this country. Although I do believe medics are becoming more commercial. So I was very honoured, really, to be able to co-found the company's called Panthera Biopartners with him. And since then, we've had 2 rounds of funding. The latest round with a very blue chip London house, which gave us this great reputational capital, but also we've now got blue chip clients, the big pharmaceutical companies, and indeed we've been involved with a lot of the very recent COVID trials. So not only have we scaled up very rapidly, I think we're between 50 and 100 staff literally within 6 months of trading, multi-million turnover and multi-million order book with potentially 10 clinics in the UK by the end of this year, including an oncology play where we're doing oncology trials. So all that being said, one, it's a business, there's a need, and everybody can make money somehow, but it's so much better making money when you also meeting a need. In fact, meeting a need is a great way to make money. We're taught at business schools, how do you delight a customer? And you delight a customer by meeting their needs. So there's an obvious need here. Second, particularly clinical trials where there's a great need. When there's a pandemic, the public sector have to, and they've done a great job in stepping up and helping the world, and in particular looking at the UK, helping the UK get over that pandemic. And we're not quite there yet, but we're certainly hopefully on the down curve of that. And obviously there's been a lot of drastic deaths that have happened, but the other side of that, it means that the public sector bodies really don't have the time or resource during periods like that to do vast amounts of clinical trials. So the fact that we can step up in the private sector and help out, I think is laudable, and hence I think that's why we both co-founded Panthera Biopartners, but also we've got a great belief in trying to help society, patients, and actually getting better medicines available onto the marketplace. Yeah,
perfect. And how do you see the company pivoting now? Because obviously, fingers crossed, we're going away from a lot of the COVID.
Yeah, well, I mean, the company doesn't do just COVID. We do all trials, so it's every therapeutic area. And in fact, the name Panthera Biopartners, Panthera is a double meaning. Pan, every, theory, theoretic, so therapeutic. So every therapeutic area we will look at. We won't do them all, but we will certainly see if we can do them. So we've got a plethora in our order book that isn't COVID. So it just so happens that we've helped with the COVID issue. That's great, but that's not necessarily the future of the company. In saying that, virology I think will be here to stay, by the way, and other virology challenges will come to be, whereas maybe in the past there's been less of an emphasis on virology. So that's just a change in emphasis, but we'll do all therapeutic areas. And indeed, we are doing already. So the idea of the company is we certainly would like to be dominant in the UK within this year. And as I say, we'll have in excess of 10 clinics in the UK. And then the next stage is internationalizing that business. And indeed, I'm actually inviting a good MBA student to come and help us with the strategy there. And we're likely to raise either more money or from our internal resources start to develop sites outside of the UK later in 2021.
Perfect. And for countries where you're looking to expand, I'm not sure if you can tell us, but are there any sort of targeted countries that you're looking to expand to?
Well, so if you look at the world map of where clinical trials are prevalent, you can actually work out, which countries it will be more beneficial for Panthera to move into. So obviously we'll move into the countries that make sense. But I think the golden rule to answer questions like that is always ask your customer. Where does your customer want you to be next? And I'm a great believer in the voice of the customer. Not only theoretically is good, but practically will lead you into the right strategic decisions. So we're asking many of our customers and future customers at the moment, where would you want Panthera to grow to help you do global trials? And indeed, that will guide us, I think, to make wise decisions going forward.
Yeah, perfect. And it's quite a unique business structure because obviously you have the pharmaceutical companies, that the B2B, and then you also have sort of the to consumer as well, which is the people who are actually
well, don't forget our clients. So patients, obviously, people do clinical trials on, but actually our customers are the large is B2B. So we don't, it's not a business relationship with the patients. It's purely the patients are there, hopefully. First of all, why do people do clinical trials? One is they believe, and I think they're right to believe, that, putting new medicines on the market that are more effective and safer and or both of the next best thing is a good thing. And particularly if they're ill with a certain disease, then it makes good sense for them to be involved in a trial where they are going to get potentially the best treatment or a better treatment that's already on the market. So there's very good reason for patients to be on clinical trials. But of course, that's not our client. Our customer is the large and mid-sized pharma and venture capital backed biotechs as well, and potentially medical device companies, because they're all going to require more clinical trials going forward as well. So I think that's going to be a new market for us, patients with medical device clinical trial needs going forward.
Definitely. Well, I think it's definitely a growing industry with the aging population and more focus on it as well. So my next question is, how has being sort of on both sides of fundraising and venture capital, how has that shaped your perspective on the VC industry?
So I actually, first of all, I'm glad I've been on both sides because, again, one of the things I teach students is hybridity, or allocentrism, I think, which is more of a business school word, is pretty important. So if you can see through the lens of more than one profession or more than one way of looking at things, often that is far superior than having two people trying to come to a consensual decision. So being a venture capitalist for a time has helped me tremendously understand what the VCs want out of this. And it means that when I go and talk to the VCs now, I can hopefully get to a deal quicker, in that it's all about negotiation. So no deal, as set, is a deal in stone. Every deal is negotiable. Yeah. There are norms, and those norms do change over time. But with the knowledge I have of the VC industry and term sheets and what is commonplace now, it becomes easier, one, for me to negotiate with my own directors and tell them what's normal, and second, to actually get a deal that works for both parties. So the art of good business, as you know, is that it's a win-win situation. So it's no good a VC doing a deal that totally obliterates the company of cash, and nor is it any good really for the VC if the company does a deal that the VC can't get their return. So there's got to be an acceptable middle ground that works, and indeed there is. And you know, a lot of my time I'd actually spend negotiating deals for other people where there's a VC involved, getting them into both a position of comfort where they can understand what the rationale is for doing certain things, and actually ending up with a term sheet that makes sense.
Yeah, definitely. And I think we've definitely seen an increase of capital available for entrepreneurs sort of in the US and around the world. So would you say that's sort of, it's trying to find that middle ground when choosing who's investing in you, or other thing? Yeah.
Well, yeah, I mean, know your audience. So, you know, there's as you say, there's a lot of money and it's cheap at the moment. So money's cheap. There's a lot of venture capital out there. You know, there's still, in my opinion, more money chasing less deals. Good deal. What I mean by less deals, I mean, there's plenty of deals, but not acceptable deals. So, you know, it's getting the deal from an entrepreneurial side into the right shape so it's VCable. You know, and it may be that it needs an angel investment prior to that. It might need a crowdfunding investment. It might need friends and family. It might need whatever. So that's where the whole scope of entrepreneurial finance comes in the sense that entrepreneurial finance is all about not just one round or about venture capital. It's about the investment journey from start to finish, and how, you know, does that tie in. And one of the great things about entrepreneurial finance, which is obviously the subject I teach, is that a deal often isn't just one source of funding. It, you know, it could have a bit of angel money investing alongside VC. It could be you know, various types of funding coming in. It could be you know, with low interest rates now, we're back to some of the deals that we used to do back in the 1980s, which are leveraged buyout deals, where you've got quite a bit of debt involved with the equity. So people now are willing to take more risk with debt because it's so cheap, and hence, you know, the concept of breaking covenants, they can deal with a lot better simply because the cost of the money, the cost of the debt is so much cheaper than it was a few years ago. So we're back. We seem to go in circles, by the way. You know, and I remember the heady days of the 70s and 80s where leveraged buyouts were, you know, were the norm, and we used to leverage up significantly, loan to equity. That went away. Now it's coming back. So again, knowing the type of funding, the where to go to for it, and also what's available on one side of the equation is important. On the other side, what does the company need? You know, I'm a great believer that you get the company strategy right first, then you get the funding right. Whereas so many people do it the other way around. They go out, chase funding, get funding, and then put the strategy, you know, either change the strategy accordingly. But, you know, a good company will set its strategy and vision, believe in it, and then get the right funding to make it happen.
Perfect. I think it's what you said before, that, you know, our business plans are always changing. You have a plan and then it's expired already. So if you raise money, then the whole world might change. So it's about being adaptable and just making sure that you can change if things happen.
Yeah. Yeah, and a lot of that is the strength of the team, the ability of the team to be able to pivot and to understand in the team who's got what strength and where to turn to make decisions. So ultimately, you know, one of the big problems I think for young scale-ups is their ability to make quick, swift, consensual decisions. And that doesn't mean to say everybody agrees. It means to say you can get agreement as to which way the company is going. And I've seen so many companies fail, not because they run out of money, or rather they do run out of money, but that's not the reason they fail. They run out of money because that's a symptom. So what is the cause of the running out of money? And often it's because they're unable to not make swift, consensual decisions, because either there's disagreement, there's paralysis on the board, there's misunderstandings, there is what I call sense hiding, where people will have an agenda that's separate to the one in the boardroom. And again, you know, that's something that I haven't yet published work on, but it's something that my research looks into. I'm a great believer in a chairperson on the board having the skills to be able to make sure that that board is able and competent to make swift, consensual decisions. Because, you know, in a scale up, the last thing you want is procrastination and at worst paralysis. What you need is quick decisions. As long as you get 10 right, sorry, let me rephrase this. As long as you make 10 decisions and get 7 right, and the other 3 aren't terminally wrong, that's got to be better than making no decisions at all. So, you know, that's basically, again, what we need scale-ups to understand. That they need to understand what the risk of not making decisions is, which is huge, and the return of making decisions, as long as some of them, even if some of them are only, you know, marginally correct.
Yeah, perfect. I think that's actually something Simon said on our podcast, where he said, you know, inaction is one of the biggest mistakes he sees. Just thinking that things will change if you keep following the same.
Yeah, and there's always a temptation as a venture capitalist to think things will get better tomorrow, you know, and it's the old adage, do they put good money after bad? And Simon's absolutely right. Simon's somebody I've got great respect for as a venture capitalist. We work very closely together, and, you know, the interesting about Simon and I is that Simon, you know, is a great venture capitalist. I'm an entrepreneur, and just about always we come into the middle and actually agree, you know, from what could be polarized decisions. So some venture capitalists would take a very, you know, more polarized, some entrepreneurs would, but ultimately is what I said before, getting to a deal means that both parties win. And you know, that's the great thing. Certainly at Warwick, when we teach together, we enjoy it because we can take opposing views and you know, show the students how you come to agreement. Yeah,
definitely. Perfect. I think we've got a visitor here, do we? Is it a cat?
Oh, yes, the cat's arrived, so I apologise. He's only a few weeks old, so yeah.
No, that's completely fine.
He often appears in many of my webinars, so he's quite famous. Probably more famous than me. So
exactly. So I'm going to sort of pivot to some of the other research you've done as well. So I know you've done a lot of research into entrepreneurial failure and the effects it has on the entrepreneur. So how does failure change us?
So what's the question at the end? How does the
failure change us? Like how does it?
Yeah. Okay. So effectively, first of all, I think that's an impossible question to answer, and let me explain why. I think it's the wrong question. I think it's how failure affects you as an individual. Then you can answer the question, how does that affect the business? So, you know, failure affects people in many different ways. I'll just remove the cat. And, you know, there's quite a lot of research on that, and there's scholars that are far more advanced in this than me. I mean, it's not particularly an area that, you know, I have a huge scholarly interest in, but certainly during my PhD, I was involved with some scholars that basically were very what's the right word, published in this area, and you know, had great respect. And what I learned from them, and also from my own experience, is that resilience, and you know, if you fail in the sense of if the company requires to be put down, the market's changed, you know, and the decisions made that effectively it's not something that's worth putting effort into. You know, the key is always to fail cleanly. So make sure your creditors are paid off, make sure you fail with respect. And, you know, that's pretty important, because if you can do that, then at least it, I think, shows people, you know, that there is respect and honesty and integrity and all those good things that you really need an entrepreneur to, you know, to demonstrate as time goes on. Yeah, sorry, the cat's been a bit
I think so what you're saying is that it's don't close all your doors. So especially if you want to get back into entrepreneurship, make sure that you have good
no, absolutely. And it's an interesting question, because failure is seen a little bit differently in different parts of the world, and you know, it very much depends why you failed also as well, and how you failed. But say you failed, you know, let's call it well, in the sense that you fell cleanly and you've not left, you know, credit, you've not done anything illegal, you've not done anything unethical, you've paid your creditors off, and you've closed things down sensibly. And there's a good reason, you know, for failure. Certainly in the States, on the West Coast, that necessarily would maybe seen actually as an asset, in that they may argue that if you've not failed once or twice, particularly, you know, I've been an entrepreneur 30 odd years now, if you've not failed in that time, then the argument is you might not be taking enough risk. And I mean, I've certainly had companies where, cleanly I've put them down, and I've had companies where I've been extremely successful. So, and I would expect that of any entrepreneur that's been in the game a number of decades. So, and I think it's very important. I think it's important teaching as well. How do you fail correctly, if that's the right phrase? Because a lot of people are frightened of it in the sense of it's an unknown and they get nervy about, lots of different things. But if it's going to be a norm within entrepreneurship, and I think it should be, hopefully not a regular norm, but certainly, it's going to be there some of the time, then there should really be a more streamlined process. And also, from the emotional side, a lot of CEOs struggle when things are going badly, and it's not when things are going well. It's easy to talk about them. It's easy for other people, to ask them questions and for them to be bullish. When things aren't going well, it's awfully quite a lonely place. Because you don't necessarily want to talk about, things not going well and et cetera, et cetera. So I do believe there's a forum for, teaching and learning and experience sharing, when things go well. But again, one of the things I tell my students, because I teach both MBA and DBA at Warwick, the entrepreneurship streams, is, most management teams can manage on the way up when things are going well. It's only the really good management teams that can manage when there are challenges on the way down, to turn that and to reverse it. And, that's the important bit of leadership. So it's not when the yacht is, in smooth waters. It's when the yacht is, all of a sudden there's a gale force wind, and you've got to work out what to do.
Yeah, perfect. So that comes on to my next question. So what are some of the major challenges that you've had in your career?
Yeah, so, I've had challenges. My career is, as I say, it's 40 years on now. So there's plenty of challenges. First of all, people is always a huge challenge. Getting the people, if people are in the wrong slot, doing the wrong job, not only are they unhappy, but most of the other people that are affected by them are unhappy. So, what I've learned there is deal with that and don't leave it. Don't let it become cancerous. Deal with it immediately. Be honest with the individual. If they need to move into another slot, move them into that other slot, et cetera, et cetera. So people, I think, is the first thing. Teams, everything. In the sense of, what we talked about before, that getting the team right is absolutely critical. So that's the first thing. Second challenge is getting the right investors. So I've had cases where, normally when I was a lot younger, if you've been raising money and all of a sudden there's a term sheet for 6 million, and you think, gee, I've been working for this for 9 months. You go out and celebrate and take it, when the reality is it was the wrong deal. Yeah. So getting the right investor base, getting traction with your customers. So again, I think if you've got customers that are willing to talk to them, because they will often give you great advice. We talked before about internationalizing, the current company that I co-founded, and I think my answer was we talk to customers, and that's maybe one thing I didn't do enough when I was younger. So again, so I think those three things are kind of the three things I would point to in terms of the challenges I've had, and how to deal with them more effectively.
Okay, perfect. And then just for the last question, it's probably a little bit related. So has there been a lesson or something that's just stuck with you throughout your career? Sort of one thing that's really stuck with you? Yeah,
and it's a great final question. So I think and this is a strange answer, but it's one that I believe, and that is what's the first criterion for doing business? And I would argue that you've got to enjoy it. So, one of the things I learned, if you're not having fun or you're not enjoying it on the whole, then actually either it's time to give up or to allow somebody else to do it. Sorry about the cat's tail now.
That's okay.
So that, I think it's very important, and that's all about having the right team where you're complementary. And it's not just about, technical skills. It's all about ability to actually enjoy each other's company. Because as we get older, obviously, life is finite. And it's pretty important. If you're not enjoying who you're with, then that is wasted time. So that's pretty important. So I think as we get older in entrepreneurial lives, one, we can actually choose in the sense that you get to know more people, and two, you've got more experience. So, that does come. But for younger entrepreneurs, it's pretty important who they get, who they find, who they co-found things with, who they spend time with, who they're influenced by. All of these things are really important.
All right, perfect. Yeah. And I think it's something that Simon, I'll link back to him as well. He said that when you back a company as well, or when you're taking funding as well, it's, do you enjoy spending time with them? Because it might not be the main reason, but it has to be one of the reasons that you're investing as well. Yeah, perfect.
Yeah, he's a wise man, Simon. So yeah.
Absolutely. Yeah. Okay, perfect. So John, thank you so much for joining us today. I really appreciate it. If anyone wanted to ask any questions or get in contact with you, how would they?
That's fine, but I really don't have the time for lots of questions. So, in that sense, it's not something I just don't have the time at the moment to deal with that. So they can always do it, hopefully via you, if there's a huge question, and we can deal with it that way.
Yeah, perfect. Or watch this video again. All right. So John, thanks again.
My pleasure. Bye for now.
Perfect. Bye. Thank you so much for listening to our podcast, and I really hope you enjoyed. If you did, if you can like, subscribe, comment, or share, that would really help the channel grow and help us get similar guests to John. Thanks again, and I hope to see you next time.